Today, markets choke on inflation risk. The DFA daily to the 15th of December 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, the latest economic data from the US has really underscored the inflationary pressures that are running over there. Prices paid to US producers posted a record annual increase, almost 10% in November, a surge that will sustain a pipeline of inflationary pressures well into 2022. The producer price index for final demand increased 9.6% from a year earlier and 0.8% from the prior month, according to figures from the Labour Department. Both advances topped economists' forecasts. The annual advance was the largest in figures back to 2010. Stocks retreated, though, as the data reinforced expectations that Federal Reserve policymakers will tighten monetary policy next year. Excluding the volatile food and energy components, the so-called core PPI increased 0.7% and was up by a record 7.7% from a year ago. Prices of goods and services both advanced last month. The report captures changes in prices paid to producers as well as margins received by wholesalers and retailers. Material costs have risen rapidly this year amid transportation bottlenecks, robust demand, and labour constraints, and many businesses have successfully passed those added costs on to consumers through higher prices, and the latest report suggests additional consumer price increases are coming in the months ahead. Of course, data out last week showed that the consumer price index rose 6.8% last month from a year ago, and that was the fastest annual pace for nearly 40 years. And while first concentrated in a handful of categories associated with the economy's reopening, inflation has now broadened out. The larger than expected sustained increase in inflation has put pressure on policymakers to act. The Fed, which will wrap up its final meeting of the year on Wednesday, is expected to accelerate the wind down of its bond buying program, an action that would allow the central bank to begin increasing interest rates next year. The persistence of inflation in recent months has proven to be a major political headache for President Joe Biden, who's trying to salvage his roughly $2 trillion tax and spending plan amid concerns from a key senator, West Virginia's as Joe mentioned, that the package will spur even more price increases. Producer prices excluding food, energy and trade services, the measure often referred to by economists because it strips out the most volatile components, was up 0.7% from the prior month, and compared to a year earlier, that gauge jumped to a record 6.9%. Goods prices increased 1.2% in November from a month earlier, reflecting broad advances that included iron and steel scrap, gasoline, fruit and vegetables. And services costs rose 0.7%, in part reflecting a jump in prices for investment portfolio management. The cost of processed goods for intermediate demand, which reflects prices earlier in the production pipeline, rose 1.5% from a month earlier, and compared with a year earlier, that measure jumped 26.5%. That's the largest since 1974. Of course, the fast-spreading Omicron coronavirus variant has also dampened investor sentiment after the S&P 500 index hit an all-time closing high late last week. The story for much of 2021, or certainly the last 6 months, has been inflationary signs that have been more and more concerning, said David Keller, the chief market strategist at stockcharts.com. So as a result of all this, the S&P 500 stumbled on Tuesday, following a rout in big tech as further signs of inflationary pressures stoked investor worries about a hawkish Federal Reserve ahead of those meetings that are taking place. The S&P 500 fell 0.75%, the Dow Jones Industrial Average slipped 0.3%, and the Nasdaq dropped 1.15%. Tech fell sharply as investors pulled their bets on high-valued growth concerns of the market, which are less attractive, of course, in times of rising rates and inflation, during which $1 today is worth more than $1 in the future. Microsoft led the sell-off in big tech. It was down about 3.26%, while Google parent Alphabet, Apple, Facebook, and Amazon were also in the red. In fact, Apple fell 0.8%, but still stayed on track to become the world's first $3 trillion company by market value. Now, the 0.8% rise in the US Producer Price Index in November was higher than the Bloomberg survey, which expected 0.5%. Now, that, of course, is a significant development, and year over year at 9.6%, it's the largest rise on record. So now everyone's expecting that the Federal Open Market Committee will announce on Wednesday a plan to double its pace of bond purchase tapering to $30 billion a month, to provide it with room to hike rates earlier to curb the threat of inflation. The pressure on the Fed to act, but after waiting on the sidelines for so long and falling behind the curve, the aggressive action arguably needed to stem the back up in costs would likely come with a significant consequence for growth, Stifel said in a note. And against the backdrop of elevated inflation and bets on less accommodative policy from the Fed, Treasury yields climbed, paring some of their losses from a day earlier. Although the financial index itself was down 1.15%, some bucked the trend, with Goldman Sachs up 1.02% and Wells Fargo up 0.72%, but investment house BlackRock was down 1.6%. Energy was also in the green, even as oil prices fell, amid concerns that the impact of the Omicron variant of COVID-19 on travel will dent energy demand. WTI oil was down 1.39% to $70.30. And Tesla fell 0.82%, adding to its recent losses after Chief Executive Elon Musk sold another $906 million worth of his shares on Monday, taking his total sale to $11.9 million. And in other news, meme stocks including GameStop and AMC Entertainment, both of which had dropped significantly, turned higher, with AMC up 5.42% and GameStop up 7.7%. Now, the US Central Bank will likely signal a faster wind down of asset purchases and thus a quicker start to interest rate hikes in order to contain the rapid rise in prices. I would say this meeting is when we will start to get some clarity on how the Fed is going to address this idea of inflation that has remained elevated and most likely will remain an issue going into next year, Keller said. Yet a recent Bloomberg poll highlighted that tapering and policy mistakes and runaway inflation were still the potential biggest downside risks, and they were way behind pandemic risks and a Chinese slowdown. And a Reuters poll of economists sees the central bank hiking interest rates from near zero to 0.25 to 0.5% in the third quarter of next year, followed by another in the fourth quarter. But a Goldman Sachs Group basket of 50 most shorted stocks has plummeted back into a bear market for the first time since June, bringing up gains for traders who sell shares they'd borrowed in hopes of buying them back at lower prices. The renewed sell-off in the more speculative corners of the market adds more evidence of a waning appetite to take risk as a new variant of the virus spreads and the Fed zeroes in on fighting inflation. And people are paying more and more attention to the fact that they're being held up by just a handful of names. Goldman's weekly Kickstart note points out that there's been a substantial decline in market breadth and that just 5 S&P 500 stocks account for 35% of the S&P 500 gains for the year. It's not just the stock market that we're seeing some of this stuff playing out. Even within crypto, a lot of the hot meme stuff from earlier this year and last year is getting clobbered. And it's notable that the degree to which blue chip cryptos like Bitcoin are starting to resemble traditional risk assets. Look at this chart comparing Bitcoin futures to the S&P 500 futures and see how similarly they behaved last Friday around the CPI report. That's the area highlighted in green. Crypto investors are closely watching this week's Federal Reserve meeting, with the market expecting the central bank to announce that faster reduction in its pace of bond buying because of the inflation issues. Facing macroeconomic uncertainties, Bitcoin has fallen more than 30% from its all-time high of $68,991 US in November and is recently trading at around $48,000. Ether is down by more than 20% from its record high of $4,865 and is recently trading around $3,830. With the Federal Reserve expected to accelerate the speed at which it tapers its bond-buying program and to signal faster rate hikes next year, crypto prices are likely to suffer further turmoil in the months ahead, Jesse Cohen, senior analyst at investing.com, said recently. Higher interest rates tend to cause violent sector rotations as investors dump risky assets, such as cryptocurrencies, for safer bets like value stocks, he wrote. And Edward Moyer, senior market analyst at forex trading platform Onya, echoed the point. The fear is that if rate hike expectations become too aggressive, Wall Street may finally get that long-awaited pullback that will send markets to a risk-off mode and punish the most profitable trade, which has been cryptos, he said. Bitcoin should remain trapped between $42,000 and $52,000, leading up to the FOMC decision and updated forecasts, he said. Bitcoin's rise for the past 2 years may be partially attributed to the popular narrative that the cryptocurrency can be used as a hedge against inflation, though Bitcoin has tended to trade in tandem with the stock market recently. Crypto markets in general have seen some phenomenal price appreciation due to its large appeal as a hedge against inflation, Richard Snow, an analyst at Forex Daily FX, wrote. Some have argued that the Fed meeting may not necessarily lead to a further downturn in major cryptocurrencies, though should the Fed surprise the market and delay the pace of the taper, Bitcoin is likely to enjoy a very fast relief rally, Matt Blom, global head of sales and trading at crypto exchange Equinox, wrote. It could also be argued that the Fed taper is already priced in, so barring signalling of an early interest rate rise, a rally is currently the most likely outcome anyhow, he said. It just shows you how much uncertainty there is out there. So we'll be looking at what the Fed says tomorrow. That will probably give us some read, but it's quite clear to me that these inflationary pressures are significantly now embedded. But remember, they do relate to supply chains, and they do not necessarily translate to embedded inflation as we saw in the 70s and 80s. And if in fact the Fed does throttle back bond buying and lift interest rates, that could really stymie growth. And so there is still a deflationary story here potentially, which is not one that the market is really currently that alive to. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.